As of this moment on Wednesday, May 6, 2026, the market is currently open and active. SOFI stock is trading at $16.14, showing a slight intraday decline of 0.37% from the morning's open. While the ticker is seeing some red on the screen right now, the volume tells a much more aggressive story. We are seeing a massive surge in institutional activity that suggests big players are quietly accumulating positions while the retail crowd reacts to the noise. You might look at a few cents of downward movement and think the momentum is stalling, but the reality is that the underlying order flow is showing a significant buildup in call option delta. This means sophisticated traders are positioning for a breakout that the general public hasn't even noticed yet. There is a specific tension building between the surface-level price action and the massive capital flowing into the credit segments of the business. Most people see a fintech company, but the real value is shifting towards its status as a high-margin national bank. The current narrative around SOFI stock is often dominated by the fear of high interest rates or the volatility of the lending market. However, the reality is that the company has effectively decoupled itself from the traditional neobank struggles. While many expected the recent earnings to show a slowdown in member acquisition, the company just reported a record 1.1 million new members in a single quarter. This brings the total to nearly 15 million people using the platform. The expectation was that the lending side would carry the weight, but the financial services segment is actually the one exploding, with revenue there up over 40% year over year. When you look at the landscape of online investing and self-investing, the competition is fierce. You have players like Robinhoodstocks trading and the various Fidelity ETFs or Fidelity mutual funds trying to capture the same audience. Yet the SOFI trading platform is seeing a higher rate of cross-buying from its members than almost any other competitor. People come for a personal loan and stay for the sofiinvest features in the SOFI robo-advisor. What investors are missing right now is the sheer scale of the technology platform segment. While the general belief is that the lending business is the primary driver, the reality is that the infrastructure side, the part of the business that powers other financial institutions, is becoming a massive moat. This is why institutional activity is staying high even when the price dips. They see the long-term play of a vertically integrated financial giant. If you are using investing sites to track your portfolio, you've likely noticed the volatility. SOFI has a high beta, meaning it moves more than the broader market, which can be terrifying for the average person holding an individual brokerage account. But for those looking for a high-growth compounder, this volatility is often where the opportunity hides. Unlike many other neobanks that rely on interchange fees, this company has a bank charter. That means they can use their own deposits to fund loans, which drastically lowers their cost of capital. This is a massive advantage that isn't fully reflected in the current $16.14 price point. Now, it is important to look at the broader sector momentum. We are seeing a rotation out of some of the older legacy financial names into more tech-forward platforms. When you compare the user experience of the Fidelity mobile app or the Interactive Brokers platform to what is being offered here, the gap in engagement is clear. The younger demographic is moving towards all-in-one apps. This is a trend that is also benefiting the Robinhood app and the SOFI active investing community. However, the diversification of revenue is what sets this apart. They aren't just relying on Robinhood crypto-style trading fees. They have a massive base of net interest income that is recurring and predictable. This creates a safety net that most other fintech companies simply do not have. Comment below how many shares of SOFI you currently hold, or if you are waiting for a lower entry point before you add to your position. Taking a step back to look at the business model, this company was founded in 2011 by Stanford students who wanted to tackle the student loan crisis. It has since transformed into a one-stop shop for everything related to your financial life. They operate three main segments: lending, financial services, and a technology platform. The lending side covers everything from student loans to mortgages, while the financial services side includes the SOFI Money accounts and the sofiinvest platform. The technology platform, powered by Galileo and Technisys, is essentially the AWS of fintech, providing the backend for other neobanks and traditional banks. This three-pronged approach allows them to weather different economic cycles. When lending slows down because of high rates, their high-yield savings accounts attract massive deposits, which they can then use to generate interest income. This is the productivity loop that the management team talks about constantly. It's not just a buzzword, it's a mechanical reality where each new product a member uses makes them exponentially more profitable to the company. The recent trading volume shows that the market is beginning to price in a more permanent level of profitability. For years, the bear case was that this company would never actually make a profit. Now that they have achieved several consecutive quarters of GAAP net income, that argument has vanished. The new tension is about how fast they can grow that profit. Analysts were looking for a specific margin in the most recent reports, and the company actually exceeded those internal targets. This is why we are seeing such a strong support level around the current price. Even with the intraday fluctuations we are seeing today, the floor is much higher than it was a year ago. Macroeconomic pressures like inflation and shifting Fed policy still weigh on the stock, but the company's ability to grow its tangible book value by over 50% year over year is a signal of extreme health. This isn't just a speculative tech play anymore. It's a maturing financial powerhouse that is starting to look more like a traditional bank in terms of stability, but with the growth rates of a software company. When you look at other options for investment help like Schwab Intelligent Portfolios or the Interactive Brokers trading tools, you see different strengths. Interactive Brokers fees are hard to beat for professionals, and Fidelity Wealth Management is the gold standard for traditional retirees. But for a person who wants their entire financial life, from their paycheck to their brokerage to their mortgage in one place, this is the dominant player. The user acquisition cost is falling because their existing members are doing the marketing for them through word of mouth and the cross-use of products.
If you look at the Robinhood Investments or Robinhood Cash Management products, they are trying to follow a similar path, but they lack the bank charter that allows for the deep integration of lending and deposits. This is the reality that is currently crushing the expectations of the bears who thought neobanks were a fad. Looking toward the future, the catalysts for SOFI stock are numerous. There is the ongoing expansion into more sophisticated investment products and the potential for a massive buyback program as their capital levels continue to rise. The risk, of course, is a deep recession that could hurt the credit quality of their loan book. However, they have focused on high-income, high-credit score borrowers, which provides a significant buffer. The expectation is that credit losses will rise as the economy cools, but the reality is that their delinquency rates have remained remarkably stable compared to their peers. This disconnect is another reason why the institutional activity is so high. They are betting that the company's risk management models are superior to what the market is giving them credit for. As we analyze the daily swings, it's clear that the $16 to $17 range is a massive battleground. If the stock can hold above $16.14 through the close today, it sets up a very bullish technical pattern for the rest of the week. We are seeing a cup and handle formation on the weekly chart that has been months in the making. If the breakout happens, the move could be swift and aggressive. This is where the tension between those who are selling for a quick profit and those who are holding for the long term becomes visible. The reality of the long-term growth story is far more compelling than the short-term noise of a 0.37% dip. Whether you are using the Robinhood fractional shares feature to build a small position or managing a large individual brokerage account, the fundamentals here are hard to ignore. The story of this stock is ultimately a story of transformation. It moved from a niche lender to a diversified financial service provider and finally into a profitable national bank. Each stage of that transition was met with skepticism, and each time the company outperformed. Today's price action is just another small chapter in that larger narrative. While the intraday movement might seem stagnant, the massive volume and institutional positioning suggest a major shift is coming. The contrast between what people believe, that neobanks are struggling, and the reality of SoFi's record-breaking revenue and member growth is the gap where the real wealth is being built. In conclusion, the analysis of SOFI stock today reveals a company that is fundamentally stronger than its current market price suggests. Starting the session at $16.14, the stock is showing resilience in a volatile environment. The expectation was for a slowing of growth and a struggle with margins, but the reality is a record-breaking member expansion and a diversifying revenue stream that is protecting the bottom line. We have seen how the company's bank charter gives it a mechanical advantage over competitors in the online investing and self-investing space, and how its technology platform creates a moat that is nearly impossible to replicate. The institutional activity confirms that the smart capital is moving into this name, even as retail investors might be distracted by small daily fluctuations. The future outlook remains bullish, driven by the productivity loop and a management team that continues to execute at a high level. The authority of the data clearly points toward a company that has successfully moved beyond its neobank roots to become a permanent fixture in the global financial landscape. We have navigated the tension between market narrative and financial reality, and the conclusion is clear. The underlying strength of the business is significantly higher than the noise on the ticker would lead you to believe. Maintain your focus on the tangible book value and the recurring net interest income, as those are the true indicators of where this stock is headed in the coming months. The disconnect between the general public's perception and the actual financial performance is providing a unique window for those who understand the mechanics of the new entering economy. While the screen might show a minor intraday red candle, the long-term chart is painting a very different, much more powerful picture of growth and stability.